is that the stock market is primarily Democratic and they think Trump is crazy, whereas the bond market leans Republican and thinks everything's fine. I believe this is the reason it's the most hated V-shaped rally. And so I got a few closing points. Well, first I just want to show you the survey. I mean, look at the UMich survey. The UMich survey, if you ask about inflation, Democrats respondents say inflation's 6%. 2 months ago, they said it was 9%. Republicans say it's 1%. So you can see there's a huge political divide.
Historically, when markets rally over 25%, sentiment becomes euphoric. But not this time. Instead, the crowd remains skeptical, sitting in cash, waiting for a crash that hasn't arrived. Lee explains that most investors went defensive in April, convinced that without Federal Reserve rate cuts or quantitative easing, recovery was impossible. Yet, as he reminds us, waterfall declines always see reciprocal recoveries.
And in fact, for the last 5 weeks, as the markets made all-time highs, the net bulls is bearish. Do you see it? Minus 11. We've had 5 weeks while the markets made all-time highs and everyone's skeptical. In fact, this is from Tireless Ken, you looked at all the times the market had a 25% or more rally, and I put a red dot, usually sentiment's quite bullish by the time you had a 30% rally. We've had a 34% rally, and yet the average sentiment is still negative. That tells me, first of all, that most people went to cash in April. They didn't think we'd recover, and I don't blame you, because I remembered at the April lows, we heard a lot of people tell us, Tom, there's no way we can recover because the Fed's not going to cut rates or expand the balance sheet, so you don't have any liquidity coming. Our argument was that waterfall declines always see reciprocal recoveries. Okay, but I believe the reason people are bearish is because of political affiliation. So please do not judge me. I'm registered independent, but I want to point out some facts. I am a registered independent, and I didn't vote for either candidate in this last election. But if you look at the general population, the US is 50-50 roughly between Democratic affiliated and Republican. Okay, so it should be half. But if you look at the University of Michigan survey respondents, and they published the affiliation, 60% of the people that respond to the UMich survey are Democrats. So when you see UMich inflation and confidence, just remember it's skewed because more people who respond are Democrats. The media, we know political affiliation is 89% Democratic. And we know that if you look at contributions by Federal Reserve employees, 92% donated to the Democratic Party. Okay, so as we run that down again, half the United States is Democratic, half is Republican. But media and the Federal Reserve skew Democratic. Well, look at the equity market. 57% of employees in the stock business are Democratic, 67% of hedge funds, and 69% of venture capital. Okay, so the equity world, or the risk-taking world, leans Democratic, which is the opposite of who's in the White House today. Whereas the bond market, 83% of those who work at savings and loans are Republican. Mortgage bankers, 64%, and commercial banks, 60%. So the bond market leans Republican. That might explain something to me, because if you ask me in 2025, why did we not get bearish? It's because the high yield market barely reacted to the tariff headlines. Spreads didn't blow out. So we figured, well, if the bond market says the economy's fine, stocks should recover. So I think the reason why you might be bearish, or your friends might be bearish, is that the stock market is primarily Democratic and they think Trump is crazy, whereas the bond market leans Republican and thinks everything's fine. I believe this is the reason it's the most hated V-shaped rally. And so I got a few closing points. Well, first I just want to show you the survey. I mean, look at the UMich survey. The UMich survey survey, if you ask about inflation, Democrats respondents say inflation's 6%. 2 months ago, they said it was 9%. Republicans say it's 1%. So you can see there's a huge political divide. I mean, unless they shop at different stores. Okay, so this is how we want to be positioned. First, we like AI and crypto. So that means Mag 7, Bitcoin, and Ethereum. But we also like industrials, financials, and small caps because that's a play on the dovish Fed. And the last set of points here is more just a reminder. The first is you have to remember the rule of 10 best days. I know there's going to be a lot of folks here who are really good at market timing. I'm not one of those. Okay, but here's the thing. Since 1928, the S&P has returned 8% a year. That's the first row. But if you missed out the 10 best days in the S&P out of the 220 trading days, your return is negative 13%. Think about that. If you missed out just on the 10 best days in the S&P, in every year, you had negative 21%, negative 13%. Since 2015, that's still true. The S&P's returned 12% a year, but if you missed the 10 best days in the S&P in 2015, since 2015, every year, you had a negative 10% return. Let me just put this in numbers for you. In 2023, the S&P was up 24%. If you missed the 10 best days, your return was only 4% in 2023. In 2024, the S&P was up 23%. If you miss the 10 best days, your return is only 4%. So you get our point. You miss out on most of the gains if you sit out the 10 best days, which is why we don't want you to time the market.
This division, he argues, helps explain the polarized perception of the economy. When a Republican administration is in power, equity markets may thrive, but the sentiment measured by predominantly Democratic-leaning institutions will remain negative. This explains in part why 2025's V-shaped recovery feels so hated. It's not about fundamentals, but political psychology.
Which is blockchain. Wall Street is finally embracing blockchain, and not because they're becoming believers in crypto. They believe that this is a way to improve the cost and productivity of their business. Okay, now this is going to take a little time to explain because I don't think people are talking about this, but let me explain to you why. If our view is correct on blockchain, Wall Street stocks like Goldman Sachs and JP Morgan are going to become a lot more profitable. Their margins are going to go up. They're going to become a lot less cyclical, and their PEs will probably look more like tech stocks. So I have to go all the way back to 1971, because in 1971, the dollar became synthetic. Now, you may not know what I'm talking about, but in 1971, the dollar was no longer convertible into gold, which means the dollar became a synthetic instrument because you could only exchange it for $1. Now think about what that means. In 1971, a lot of folks got scared and they said, well, I want to buy gold instead. And actually that was a great investment. But if everyone bought gold, the US economy would have collapsed, right? Because the dollar represented nothing but itself. So you had to create a system where people would believe the dollar was useful, and that was what Wall Street did. They created all these financial products because the dollar became synthetic. Money market funds in 1971, currency futures in 72, debit cards in 78, mortgage-backed securities, currency swaps, interest rate swaps, S&P futures, zero coupon bonds. I mean, a lot of these you guys all remember, exchange traded funds. If Wall Street didn't do that, another currency would have become dominant. But that's not what happened, right? The dollar today is 80% of all financial transaction quoted pairs. So when we went to a gold, off the gold standard, the dollar became the dominant pair. And in fact, 7 of the top 30 largest companies in the world are banks, including JP Morgan, Visa, MasterCard, B of A, etc. Okay, well, in 2025, which is 2 generations later, it's not just the dollar that's becoming synthetic. Everything is going to become synthetic. Let me explain that. The first is the Genius Act, which is what Congress passed earlier this year, which creates the stage for a stablecoin boom. And then the SEC announced Project Crypto, which is encouraging Wall Street to move on to the blockchain. Remember, the blockchain is a public software, basically gigantic public software, but what it does is it verifies transactions and it stores records and information, and it eliminates a lot of the costs and friction that Wall Street experiences today. In fact, Treasury Secretary Bessent believes that just the stablecoin market could be $3.7 trillion compared to $250 billion today. That's exponential growth as we start to see Wall Street move things synthetically onto the blockchain. So what does that mean? Well, if everything's becoming digital, okay, you've heard a lot of people say, well, you want to find the digital store of value, the digital gold, which is Bitcoin. And that makes a lot of sense. That's what Fundstrat has been advocating for since 2017. That was more than 8 years ago. And in fact, Tireless Ken remembers when we first started writing about Bitcoin in 2017 and we said it would be institutionally adopted as digital gold, people ridiculed us. We lost a lot of customers actually because they thought we really lost our grounding to reality. But as you know, 8 years later, that's the narrative. Bitcoin is digital gold. Well, let's think about the next 10 to 15 years. Wall Street's going to build a market for digital assets. Now, for reasons I won't cover here, it's going to be on Ethereum because that's really where everyone is building this future. But the thing I want to highlight today is that Wall Street is going to build a market for digital assets onto the blockchain. So it's more than just dollars, it's everything. So think about this. There's 2 story arcs that are going to be the next 10 to 15 years why I think it's the biggest macro trade. The first is stablecoins, the upward one. Stablecoins, we're going to tokenize stocks. NASDAQ actually just approved that this week. We're going to tokenize credit, tokenize real estate. Maybe we'll monetize our reputations on the blockchain so we can value that. And we'll monetize intellectual property, which, as you know, is the largest component of CapEx today. So if you look at GDP data from BEA and you look at what they call private investment spending, the largest share of that is intellectual property. That is easily moved onto the blockchain. But then there's another story arc. If you're going to be able to digitize that information, you're going to monetize data collection, royalty streams, loyalty programs. As you know, that's a huge business, is the value of your frequent flyer miles. Then there's going to be agentic AI and things like proof of humanity. So that all is what you're going to see in the next 10 to 15 years. This is the biggest opportunity for Wall Street ever.
To understand this, Lee takes us back to 1971, when President Nixon ended the US dollar's convertibility into gold, effectively making the dollar synthetic. The dollar was no longer backed by gold. It was backed only by itself. That shift forced Wall Street to create financial instruments to preserve the dollar's utility and global dominance.